Picture a Tuesday morning, March 4th, 1952. A man named Gerald Haas walks into the First National Bank of Cincinnati with an envelope in his coat pocket. He is a machinist. He has worked the same factory floor for 19 straight years. Inside that envelope is $4,200 in cash, every dollar earned by calloused hands and stolen sleep. He slides it across the counter with quiet pride. The teller smiles, rubber stamps the ledger, and tells Gerald that his money will be safe here. It will grow. Every single year, the bank promises, his balance will be larger than the year before. Gerald dies in 1991. His daughter Margaret clears out his personal files. She finds the original deposit slips from 1952, along with every annual bank statement he ever received. She lines them up on the kitchen table in chronological order. On paper, Gerald's account had grown. The numbers were bigger every year without a single exception. He had never withdrawn, never panicked, never made a single bad decision. But Margaret has a calculator and a price index, and what she discovers stops her cold. What Gerald deposited in 1952 could buy a reliable used car, 6 months of groceries, and still leave enough for a family vacation. What that same account held in 1991, adjusted for what a dollar could actually purchase, was worth less than half of what he put in. In 39 years of disciplined, uninterrupted saving, Gerald Haas lost more than $2,100 in real purchasing power. Nobody stole it. No crash consumed it. No bad investment swallowed it whole. It was taken from him slowly, invisibly, one silent percentage point at a time. This is not a story about Gerald's misfortune. This is a story about a system that was engineered to work exactly this way. It is a story about the most elegant theft in human history. The thief never breaks a window. The thief never touches your account number. The thief holds the printing press, controls the interest rate, writes the regulation, and smiles warmly every time you make a deposit. The ledger always shows growth. The balance sheet always looks healthy, but the balance sheet lies. Let that number sink in for a moment. Every single day you hold cash in a standard savings account, you are participating in a transaction you never agreed to. The bank pays you somewhere between 1% and 4% interest annually. Inflation, the quiet erosion of each dollar's ability to buy something real, runs at somewhere between 3% and 7% during normal years. The math is not complicated. It is brutal. You are running on a treadmill designed to move backward faster than you can walk forward. To understand how this became the permanent condition of modern life, you have to go back to when banking was still considered a noble institution. The great banks of the early 20th century projected permanence. Marble floors, brass rails, mahogany desks polished to a mirror shine. The architecture alone was a message, a declaration that this building, this institution, this system would outlast you, outlast your children, outlast the very concept of uncertainty. Walking into a bank in 1930 felt like walking into a cathedral. The message was identical. Place your faith here, and you will be protected. The Federal Reserve had been created in 1913, less than 2 decades earlier. Its stated mission was stability. It was the great financial cathedral of cathedrals, the institution behind all the other institutions. The men who designed it spoke in the language of permanence, of anchors, of foundations. They compared the dollar to bedrock. Immovable, trustworthy, a thing you could build a life on. And for a brief, shimmering period in the middle of the 20th century, it actually felt that way. The post-war years were extraordinary. Between 1945 and 1965, the American economy produced something close to a genuine miracle. Real wages rose year after year. Homeownership climbed. A factory worker with a high school diploma could genuinely support a family, buy a house, and save for retirement. The dollar was linked to gold at $35 per ounce under Bretton Woods, and the gold link created a ceiling that inflation could not climb past. The system had a governor. It had a limit. It had teeth. But beneath the gleaming surface, beneath the rising GDP and the swelling pride of post-war prosperity, the foundation was already rotting. The rot was not dramatic. It was not a villain in a dark room giving orders. It was a structural weakness that had been baked into the architecture from the very beginning. And the name of that weakness was the same as it always is: debt. The United States government had spent enormously during the Second World War. It had spent again during Korea. It was spending in Vietnam by the late 1960s, spending on the Great Society programs, spending on the space program, spending with the accelerating urgency of a nation convinced its power was permanent and its credit was infinite. By the late 1960s, foreign governments were beginning to notice a troubling discrepancy. The number of dollars circulating in the world far exceeded the amount of gold sitting in Fort Knox. The gold window, the promise that any foreign government could exchange dollars for gold at $35 per ounce, was becoming a fiction. France was the first to call the bluff loudly. President Charles de Gaulle stood at a press conference in 1965 and said, with unmistakable precision, that the dollar's privilege of settling deficits with its own currency was a structural injustice. France began converting its dollar reserves into physical gold. Other nations watched and quietly began doing the same. The gold in American vaults was draining. By 1971, the United States held roughly 8,100 metric tons of gold against foreign dollar liabilities that had swollen to more than $70 billion. The math was already broken before anyone admitted it publicly. On August 13, 1971, a small group of men gathered at Camp David for a secret weekend meeting. There were no press releases. There were no formal announcements scheduled. The Treasury Secretary, the Fed Chairman, the Council of Economic Advisors, and a handful of senior staff sat around a table and confronted a ledger that could not balance. Foreign nations were demanding gold. The vault could not cover the claims. The system was insolvent. Not theoretically. Actually, the meeting produced a decision that would permanently alter the financial architecture of the entire planet. Nixon would go on television Sunday evening and close the gold window. The dollar would no longer be redeemable for anything real. It would float, anchored to nothing, backed by nothing except the full faith and credit of a government already running deficits it could not close. This is the smoking gun. This is the document, the decision, the specific weekend when the rules changed. It was not called a default. It was called a suspension, a temporary realignment, a technical adjustment. The language was designed to obscure the magnitude of what had happened. What had actually happened was a foreclosure on the original promise. Every dollar that existed before that weekend carried an implicit claim on a fixed quantity of gold. After that weekend, it carried a claim on nothing. The liquidation sale was quiet. It happened on a Sunday evening. Most people were watching television. The Federal Reserve, the institution behind every bank that had promised Gerald Haas's money was safe, was now the single most powerful price setter on earth. It could set short-term interest rates. It could expand or contract the supply of money. It could, in effect, decide how fast every dollar in every savings account would lose its value. And the addiction that now took hold was invisible because it was designed to be invisible. Inflation was not supposed to feel like theft. It was supposed to feel like progress. Prices going up meant the economy was growing. Rising wages meant workers were prospering. The numbers on every bank statement kept climbing. Nobody was supposed to notice that the floor was sinking. The 1970s revealed what happens when the machinery accelerates. Consumer price inflation, which had averaged under 2% per year in the 1950s and early 1960s, hit 5.7% by 1970. It climbed to 8.7% in 1973. By 1974, it reached 12.3%. A family who had deposited $50,000 in a standard savings account in 1971, earning the regulated maximum of 5.25% annual interest, watched their nominal balance grow obediently every single month. But in 1971 purchasing power terms, that growing number was shrinking. By the end of 1979, their nominal balance had reached approximately $84,000. Their real purchasing power, adjusted for what those dollars could actually buy, had collapsed to roughly $41,000. They lost nearly $9,000 in real value while believing they were saving. Think about the scale of that. There is a specific mechanism that makes this theft so efficient. It is called Regulation Q. From 1933 through 1986, the Federal Reserve imposed legal ceilings on the interest rates that commercial banks could pay depositors. In the 1970s, that ceiling was 5.25% for savings accounts. Inflation was running between 7% and 14%. The spread between what you earned and what you lost was not an accident. It was a legal guarantee. Banks could not compete for your money by offering higher rates. The government had made it illegal to fully protect yourself. You were required by regulation to lose purchasing power slowly. The trap had a ceiling and no floor. The antagonist in this story is not a single banker or a single politician. The antagonist is the mechanism itself. It is the compound logic of a system where governments need inflation to erode their own debts, where banks need your deposits to multiply their lending, and where the interest rate you earn is always calibrated to be just generous enough to keep you from asking harder questions. Every quarter point increase the Federal Reserve announces is covered as good news for savers. But savers are only winning when the interest rate they receive exceeds the inflation rate they experience. That condition has been true for only scattered years in the last half-century. The modern version of this trap is more sophisticated and more invisible than anything Gerald Haas ever faced. The average American savings account in 2024 paid approximately 0.46% in annual interest. Official consumer price inflation ran between 3.4% and 4.1% for much of that year. The annual real loss on a $100,000 deposit was somewhere between $2,940 and $3,640, depending on which month you measured. Every single day, that account holder woke up marginally poorer in real terms while their statement told them they were marginally richer. The statement is technically accurate. The statement is functionally a lie. Now here is where the story turns darker. The mechanism has been updated for a new era. The old version relied on explicit inflation eroding explicit savings. The new version is more subtle. Central banks around the world, including the Federal Reserve, the European Central Bank, the Bank of Japan, and the Bank of England, now explicitly target a 2% annual inflation rate as a policy goal. This is not an accident they are trying to prevent. This is a destination they are steering toward. A 2% annual inflation rate means your purchasing power is cut in half in approximately 35 years. At 3%, it halves in 23 years. At 4%, you lose half in 18 years. The target is designed to make the erosion slow enough to be invisible and fast enough to matter enormously over a lifetime of saving. This is what sovereignty over your own labor actually looks like. You spend 35 years working, earning, and diligently setting aside a portion of every paycheck. The system rewards this behavior with language like financial responsibility and prudent saving. But the system is also quietly running the extraction mechanism in the background, and the longer you save the approved way, the more completely the mechanism works. The most disciplined savers are the most efficiently harvested. Patience, in this context, is not a virtue. It is a vulnerability. The behavioral trap is as deliberate as the financial one. Most people understand, in the abstract, that inflation exists. Most people know that prices rise over time. But the human brain is extraordinarily bad at perceiving slow, continuous losses. We are built to notice sudden shocks. A stock market crash in a single day creates panic, news coverage, emergency meetings. An inflation rate of 3.5% running for 20 consecutive years erases more wealth than most market crashes ever did, but it generates no panic because it generates no single catastrophic moment. There is no Black Monday for a savings account. There is only Monday, then Tuesday, then Wednesday, each one slightly more expensive than the last. The Federal Open Market Committee holds 8 scheduled meetings per year. At each meeting, the 12 members who hold votes on monetary policy collectively decide the federal funds rate. That rate is the mother of all other rates. It sets the ceiling on what banks can earn from lending and, therefore, the ceiling on what they will pay you to deposit. But the committee's mandate also includes employment, not just price stability. When unemployment rises, the committee tends to cut rates and accept higher inflation to stimulate growth. When they cut rates to zero, as they did between 2008 and 2015 and again between 2020 and 2022, the extraction mechanism runs at maximum efficiency. Savers earn nothing. Inflation runs. The real value of every dollar in every account bleeds out quietly and continuously. Between January 2020 and December 2022, the effective federal funds rate spent nearly 2 full years at essentially 0%. During that same period, cumulative inflation hit approximately 14.7%. A person holding $200,000 in savings during those 30 months lost, in real terms, approximately $29,400 without a single crisis, without a single scandal, without a single headline that described it as a loss. It was called monetary accommodation. It was called stimulus. It was, by any honest accounting, a silent transfer of purchasing power from savers to borrowers, from the patient to the leveraged, from the careful to the indebted. Sovereignty, as always, belongs to solvency. And in this game, the solvent are the first to be quietly taxed. The generational math is what most people never calculate because it requires thinking across decades, and most bank statements only show you the last 30 days. Consider a household that begins saving $1,000 per month in 1985. They are disciplined, consistent, and they keep every dollar in FDIC-insured accounts, exactly as the financial establishment recommends. By 2025, 40 years later, they have deposited $480,000 in principal alone. With average interest rates during that period, their nominal balance approaches roughly $780,000. That sounds like a success story. But in 1985 purchasing power, the real value of that $780,000 in 2025 is closer to $280,000. They deposited $480,000 worth of $1,985 and got back $280,000 worth of $1,985. The statement showed growth every single year. The ledger, the honest ledger, shows a loss measured across a generation. The people who figured this out earliest paid an enormous social price for being right. In the 1970s, economists who warned that the inflation was structural, not temporary, were dismissed as alarmists. Analysts who suggested that cash savings were a losing proposition were called unpatriotic, were told they were undermining consumer confidence, were accused of working against the American economy. The institutions that were quietly extracting value from those savings accounts had a deep incentive to suppress the counter-narrative. They controlled the access to capital, the regulatory framework, and the mainstream financial press. Being right about monetary debasement did not protect you. It only allowed you to prepare. Modern central banks no longer hide their stance. Institutions like the Bank for International Settlements openly argue that steady, moderate inflation is necessary for economic stability. The Federal Reserve's dual mandate accepts inflation as a built-in feature of the system, not something to eliminate. The European Central Bank frames its inflation target as a goal to reach, not a strict ceiling to avoid. The structure of modern monetary policy rests on a clear premise. Your money is expected to lose value over time. This is discussed publicly and taught academically. What's rarely explained is what that reality means for ordinary savers. Go back to 1952. Gerald Haas in Cincinnati wasn't reckless or financially naive. He followed the advice every respected institution promoted. Save inside the formal system. Trust the banks. Let compound interest do the heavy lifting. He did exactly what he was told. The written rules rewarded discipline, patience, and loyalty to the system. And based on what he could see, he was making the responsible choice. What he couldn't see were the invisible mechanics working beneath the surface. The real rules weren't printed on his monthly statement. They lived in the gap between interest rates and inflation, in regulatory ceilings, in policy decisions made far from his kitchen table. The description of the system and the reality of the system had quietly separated. By 1991, his daughter Margaret understood something he never had the chance to grasp. A bank account is not a vault. It's a pipe. And that pipe has a slow, engineered leak. The leak isn't an accident. It's embedded in the design. Each day money sits idle. Purchasing power slips away at a pace calculated to feel harmless until years pass. Understanding that mechanism changes perspective. The system won't adjust because you recognize it. But awareness is the first step toward protecting what you've earned rather than watching it quietly erode.